Welcome to the Deep Dive.
Uh,
Today we're going to be tackling The Little Book of Common Sense Investing
so?
by John C. Bogle.
Mm-hmm.
You might know him as the founder of Vanguard,
Yeah.
the company that really put index funds on the map.
Yeah.
This book is a classic for a reason.
Right.
It lays out a path to building wealth that cuts through all of Wall Street's noise.
And what's surprising for a lot of people
Yeah.
is that Bogle's central idea is this.
Yeah.
Most folks shouldn't try to beat the market.
It's almost counterintuitive.
Yeah.
We're bombarded with messages about finding the next hot stock or
Wow.
timing the perfect buy and sell.
Yeah.
But Bogle argues that for the vast majority of investors, that's a losing game.
He pulls no punches when laying out the data.
Yeah.
He shows how difficult it is to consistently pick winning stocks
Well, yeah.
or time the market just right.
Right.
And even if you find a fund manager who's hot for a few years,
Mm.
the odds of them keeping that up over decades are slim.
Okay, so no trying to be a stock-picking genius.
Right.
What's the alternative then?
Index funds.
Okay.
And here's where things get really interesting.
Okay.
An index fund simply aims to match the performance of a specific market index, like the S&P 500. It doesn't try to outperform, just capture the market's overall growth.
Yeah.
Sounds boring.
Well, on the surface, maybe.
Yeah.
But Bogle makes a convincing case
Right.
that it's anything but boring, especially when you look at the long-term returns.
Exactly. There are a few key reasons
Okay.
why index funds work so well for the average investor.
Okay.
First, they have incredibly low costs.
Mm-hmm.
Since they're not paying a team of analysts to pick stocks or
Okay.
making frequent trades,
Yeah.
their fees are tiny
Mhm.
compared to actively managed funds.
Okay.
That means more of your money is actually working for you.
I'm starting to see why those low fees could make a big difference over time.
Think of it this way.
Okay.
Imagine two runners in a marathon. Okay. One is carrying a heavy backpack full of fees,
Mm-hmm.
while the other has a light fanny pack.
Okay.
Who do you think has a better chance of winning?
Oh, I like that analogy.
Yeah.
It makes the concept of humble arithmetic,
Right.
one of Bogle's key terms,
Yeah.
much easier to grasp.
And that leads us to the second big advantage of index funds.
Okay.
Diversification.
Diversification, right?
Instead of putting all your eggs in one basket,
Yeah.
an index fund spreads your investment
Mm-hmm.
across hundreds or even thousands of stocks.
Right?
If one company has a bad year,
Yeah.
it won't tank your entire portfolio.
So it's like built-in risk management
Exactly.
without needing to be a financial expert yourself.
Exactly.
I like it.
Now, to see how this all plays out in the real world,
Okay.
let's compare two hypothetical investors.
Okay.
Investor A puts money into an actively managed fund
Okay.
with a 2% annual fee,
Mm-hmm.
while Investor B goes with a low-cost index fund with a 0.2% fee.
Okay.
Let's say both funds see an average 7% annual return before fees
Right.
for 30 years.
Yeah.
It doesn't seem like a huge difference at first, right?
But something tells me those fees are going to add up over time.
They do.
How big of an impact are we talking?
Well, Investor A ends up with about $432,000.
Okay.
Not bad, right?
Yeah.
But Investor B, thanks to those lower fees,
Yeah.
ends up with over $605,000.
Oh, wow.
That's a difference of more than $172,000.
Wow. Okay. That really puts it into perspective.
Yeah,
It's not about getting lucky with a hot stock pick.
right.
It's about letting the market do its thing
Exactly.
while minimizing the drag of those pesky fees.
Precisely.
Okay.
Bogle's whole philosophy is about tilting the odds in your favor. He's not saying you'll get rich quick,
Right.
but rather that by following these simple principles,
Yeah.
you can build wealth steadily and reliably over the long term.
It's a refreshing approach,
Yeah.
especially for someone who's just starting out or maybe feeling overwhelmed by all the complexity of the market.
Absolutely.
Yeah.
And here's a question to ponder.
Okay.
If you could go back in time and give your younger self one piece of investment advice, what would it be?
It's a great question.
I'll pick up on that thought in part 2,
Okay.
where we'll dive deeper into Bogle's specific strategies.
Awesome. Looking forward to it.
Yeah.
Welcome back to the deep dive. Before the break,
Yeah.
we left you with a question.
Right.
What investment advice would you give your younger self?
Mm-hmm.
It's something to think about as we dig deeper into Bogle's approach.
It's a question that really gets to the heart of Bogle's philosophy.
Yeah.
He wanted to empower people
Mm.
to take control of their financial futures.
Yeah.
And a big part of that is understanding the tools at your disposal.
Right. So let's get into those tools.
Okay.
We've talked about the advantages of index funds,
Yeah,
but are there specific types Bogle recommends?
absolutely.
Okay.
One of his core suggestions is to start with a broad market index fund that tracks the entire U.S. stock market,
Okay.
like the S&P 500.
Right.
It's essentially buying a tiny piece of all those companies, giving you instant diversification.
Makes sense.
Yeah.
But Bogle wasn't just about stocks.
Right.
He also emphasized the importance of bonds, right?
He did.
Didn't he have some specific advice on how to incorporate them into a portfolio?
He did.
Okay.
He saw bonds as the ballast to the stock market's volatility.
Okay.
He recommended a certain percentage of bonds based on your age, but also stressed that it's not one size fits all.
Right.
It depends on your risk tolerance and when you'll need the money.
Right.
Someone nearing retirement might want a larger portion in bonds for stability, while a younger investor could tilt more towards stocks for growth potential.
So it's all about finding that right balance for your situation.
Exactly.
But how do you actually resist the temptation to try and time the market, especially when the news is screaming about the next big crash or boom?
Bogle called market timing a fool's errand.
Yeah.
He argued that even professionals struggle to predict short-term swings, and individual investors are much better off ignoring the noise.
So just stay the course.
Yeah, he advocated for time in the market.
All right.
Not timing the market.
I like that.
Consistently investing, regardless of what's happening day to day.
Easier said than done, right?
It is.
It takes real discipline to stick to the plan when things are turbulent.
It does. And this is where having a well-defined investment strategy is crucial.
Okay.
It helps you stay focused on your long-term goals and avoid making emotional decisions based on fear or greed.
So let's talk about building that strategy.
Okay.
Where do you start?
First, get clear on your financial goals.
Yeah.
What are you saving for? Retirement?
Yeah.
A down payment on a house? Your kid's college fund? Once you know your destination, you can figure out how much risk you're willing to take to get there.
And then based on your risk tolerance and time horizon, you can determine the right balance between stocks and bonds.
Exactly.
Your asset allocation.
Your asset allocation, right?
Okay.
Within each asset class, you can choose specific index funds that align with your overall strategy.
Gotcha.
Now, Bogle was very clear that for most investors, picking individual stocks is a bad idea.
He felt it was like trying to outsmart the collective wisdom of the entire market.
He did.
Right.
Unless you have a very deep understanding of a particular company or industry, he felt it was best to stick with the diversified approach of index funds.
Right.
It's about tilting the odds in your favor,
Yeah.
not trying to be a stock-picking hero.
And of course, all of this relies on having patience.
Right.
That long-term perspective that Bogle was always advocating for. He famously said, the stock market is a giant distraction to the business of investing.
He believed too much focus on short-term fluctuations would lead people to make impulsive decisions. Remember, it's a marathon, not a sprint.
And even though it sounds simple, this long-term approach can be surprisingly powerful.
Absolutely.
Yeah.
It's like that old saying, the best time to plant a tree was 20 years ago.
Yeah.
The second best time is today.
I like that.
Even small, consistent investments made early on can really blossom over time thanks to the magic of compounding.
So as much as Bogle was known for his views on investing, he also had some pretty strong opinions about how corporations should be run. He wasn't afraid to call out what he saw as problems in the system.
He wasn't shy about it at all.
Okay.
In part 3.
Yeah.
We'll take a look at some of his broader criticisms of the financial industry and how he felt corporations should be focusing on long-term value instead of short-term profits.
We're back for the final part of our deep dive
into
the little book of common sense investing. So far, we've really focused on Bogle's advice for individual investors, but he was also known for being a vocal critic of the financial industry itself.
That's right. He wasn't afraid to challenge the status quo,
Yeah.
even if it ruffled some feathers.
Yeah. He didn't hold back.
One of his biggest criticisms was aimed at the whole culture of active management and the high fees associated with it.
He felt like this system wasn't always serving the best interests of the average investor.
Yeah, he argued that many actively managed funds were more focused on enriching the fund managers than on delivering consistent returns for their clients.
Good point.
He pointed out that even if an actively managed fund performed well, those hefty fees could take a big bite out of the investor's profits.
And as we've discussed, very few fund managers actually manage to beat the market consistently over the long term.
It's tough.
So it's like you're paying a premium for performance that you're unlikely to get.
Yeah, he believed that the whole system was built around short-term thinking and chasing returns. Which ultimately created a lot of unnecessary risk and expense for investors.
So his solution was to step away from that whole game and embrace a more passive approach through index funds.
Right. He championed the idea that you could achieve solid returns by simply owning the market rather than trying to outsmart it. It was a pretty radical concept at the time, but it clearly struck a chord. Millions of investors have embraced index funds, proving that his approach really works.
It's pretty amazing how he revolutionized the investing landscape, making it more accessible and less intimidating for everyday people.
Absolutely.
But his critiques went beyond just fees and active management. He also had some strong opinions about how corporations themselves should be run.
He was a big believer in long-term value creation. He felt too many CEOs were obsessed with short-term profits and quarterly earnings reports, which could lead to decisions that ultimately hurt the company down the line.
It's like they were sacrificing the health of the tree.
That's a great way to put it.
To grab a few quick apples.
Yeah. He felt this short-term focus often came at the expense of things like investing in research and development, employee training, and other initiatives that are crucial for sustainable growth.
He was calling for a shift in mindset.
Absolutely.
A return to focusing on building strong, enduring businesses that could thrive for decades, not just for the next quarter.
Exactly. And he believed that this would ultimately benefit everyone involved, the companies themselves, their employees, the communities they operate in, and of course the investors.
He really saw investing as intertwined with larger social and economic issues. He believed that businesses had a responsibility to society as a whole, not just to their shareholders.
His approach was very holistic. He wasn't just about making money. He was about making a positive impact.
And he really walked the walk at Vanguard.
He did.
Building a company that reflected those values. A company known for putting its clients' interests first. It's inspiring to see how his vision has resonated with so many people.
His message is more relevant than ever in a world of constant distractions and get-rich-quick schemes. He reminds us that building wealth is about patience, discipline, and sticking to a solid plan.
So to wrap up our deep dive, I think one of Bogle's most powerful quotes really sums it all up.
Yeah, what is it?
He said, "The greatest enemy of a good plan is the dream of a perfect plan."
Don't let the pursuit of perfection hold you back. Start investing today, even if it's a small amount. Be consistent. Stay disciplined and let the power of compounding do its work.
And remember, the most important investment you can make is in educating yourself.
Absolutely.
Learn the basics, develop a sound strategy, and don't be afraid to seek guidance if you need it.
Thank you for joining us on this deep dive into the Little Book of Common Sense Investing.
It's been a pleasure.
We hope you've gained some valuable insights and feel empowered to take control of your financial future.
Until next time, keep learning, keep exploring, and keep diving deep.